God, if I hear one more thing about private credit, I can't. I just can't. Okay, school's in session. Let's talk about private credit, which is Wall Street's latest golden child. You may have heard the buzz. Access to private markets is opening up, new income strategies, diversification. But here's the thing, look, whenever Wall Street is too eager to sell something to the masses, what is it I always say? I always say the same thing. It's always worth asking who's really making the money and what are your risks? It's a gold rush happening, right? So that's why I'm always sus whenever you see things in print over and over again about this particular product is great, or this particular thing is great. I always got to ask. So anyway, what is private credit? Private credit refers to non-bank lending to private companies. So think like middle market businesses that don't issue public bonds or get traditional bank loans. Instead, they borrow from private funds, often at higher interest rates. So this asset class is completely blown up in the last decade. Over 1.6, 1.7 trillion to a trillion globally. And it's available now to individual investors through interval funds, which is sort of like they look and smell a little like mutual funds, but they're not. Private business development companies, different kinds of mutual fund wrappers with quarterly liquidity. So yes, you can now invest in private debt, kind of like the big boys do, but it's not the same game. So why is it so hot right now? Private credit looks very sexy because it often pays big yields, like 8 to 12% yields. And allegedly, it is uncorrelated to the stock market. That's arguable, but allegedly. It's pitched as income producing and less volatile than public bonds. And let's be real, banks have pulled back. Like, what's your interest rate that you're getting on any sort of savings account at the bank, unless it's like a special deal or a CD? The answer is next to nothing. They don't really want your cash sitting there. So private lenders are stepping in to fill the gap. Plus, with interest rates elevated, these loans reset higher, so they're earning big for now. Asset managers, they're racing in to roll out new products. They're out every day with this stuff. Why? Because it is a fee machine. Do you hear the cash register going? I do. So it makes sense for the firms, but does it make sense for you? Let's talk about the pros and the cons. So to be fair to private credit, it can offer attractive income in an era of low bond returns-ish. It can offer lower correlation to equities, so it diversifies you out, and it's a chance to invest in what I would call real economy lending, especially when public credit markets are tight. So some funds do a good job managing the risk, especially those with experienced underwriting teams and conservative loan to value ratios. That's the key here. But let's talk about the cons and why I'm a doubting Thomas, as it were. Here's the big red flag. When Wall Street starts wrapping complex assets into slick packages for mass consumption, risk gets buried. Do we not remember 08, 09? Like, I was there for that. I mean, we were all there for that. So let's talk about the risks of private credit. It's illiquid. Many private credit funds lock you up for quarters or even years. Opacity, that's a big one. You can't really see what's in there. You may not know what's in the portfolio or just how risky the borrowers are. I'm looking at you, CDOs. Okay, I'm looking at you. Defaults. Now, if the economy slows, which hint, hint, I mean, I'm hearing a little echo out there around that. Middle market companies are where the cracks start. And then there's like little games that get played around the valuation. Some funds don't mark to market regularly. So basically you don't really know what it's really worth. So the drawdowns may lag reality. And the worst thing of all is retail investors are being handed exposure after the institutions and insiders have already locked you out of the best deals. So I would call that the tail end of the gold rush. So it can be useful. It's not a magic bullet. If you're going to wade into it, do it with clear eyes. Do not kid yourself that this is going to be some solve for your financial woes. Know what you're owning. Do a little homework. Look under the hood. Ask lots of questions. Because look, in the end, someone is going to win at this gold rush, and it usually ain't you. Hi, I'm Jennifer Kirby from Talisman Wealth Advisors, and I'm here to give advice and insight and help you do money better. So if you like what I have to say, please be sure to like, to share, to comment, and to subscribe. Thanks.